a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
In case you haven't looked lately, as of this conversation, the price of gold back on the upswing. And with that, there might be some ETFs that are worth considering. Our ETF Research Director, Nina Mishra, fills us in on all of that. So why, first of all, is gold such a hot trade? I mean, up 14% so far this year?
So yeah, it has been the hottest trade, one of the hottest trades of the year.
Yeah.
And this is the best start for the precious metal since 1980 per Financial Times, even though we saw some profit taking yesterday, but it is up again. And I think this rush to gold and other safe havens is a direct result of concerns about global economy, including China downturn, oil price plunge, and then earnings recession here in the US, and of late, all those concerns about the health of European banks. And, investors are also getting concerned that global central banks may be running out of ammunition. You know, what happened in Japan a couple weeks back, Bank of Japan introduced negative interest rates, aiming to lower the value of yen and boost the stock market. But opposite of that happened after the announcement. Yen soared and Japanese stocks fell. And these negative interest rates in Japan, as well as in some of the major European countries, are also helping the bullish trend for gold. Because gold critics often argue that it is an unproductive asset, it doesn't pay anything to holders, and that makes sense when interest rates are high. But that argument doesn't, it's not valid when interest rates are so low or negative, because in that case, the opportunity cost of holding gold is almost nil. And then there are supply and demand factors. Supply has been going down. Per a report from the World Gold Council, supply fell during the fourth quarter for the first time since 2008, and they expect this trend to continue because mining firms have cut investments after years of losses. And demand is going up in China and in India, two largest consumers of gold in the world, particularly in China, because people are, losing faith in their currency and their stock market. They are pulling money out of the country because they feel that the currency is going to weaken further. Almost 100 billion left China during the month of January alone. And now the government there is trying to put restrictions on capital outflows. And if they put more restrictions, then I think people, if they are not able to take their money out, they will put more money in gold bullion and all that, because they want to protect their wealth. So all these, a combination of all these factors is, bullish for gold, and I think some allocation to gold and portfolio makes sense. All
right, at least as of this conversation on February the 17th, right? So any of those dynamics that you talked about could change at any time going forward. But for the meantime, you've got a couple of gold ETFs that are actually backed by the physical metal.
Yes, they actually hold the precious metal in their walls. So these are the two most popular physically backed gold ETFs, the Spiders Gold Trust. The ticker is GLD. It's a massive ETF with more than $28 billion in assets under management, expense ratio of 40 basis points. And most people know this ETF, GLD. It's a very popular ETF. The other one is not so popular, even though this also has more than $7 billion in assets under management. And most investors do not know that this provides the same exposure, but at a lower cost of 25 basis points. But GLD is, because of its massive size and huge trading volumes, the trading costs for GLD are very, very low. So it makes more sense to invest in GLD for traders and trading portfolios, whereas IAU is more suitable for longer term holdings or buy and hold investors.
All right, in addition to the physical metal, we can't forget about the gold miners.
Yes, so whatever is good for the metal is better for miners, because they are leverage plays on the metal. So if the metal goes up, they go up more, and if gold falls, they fall more. So obviously it is a higher risk play with higher return potential as
Okay.
well. And investors should also remember that most of these gold miners ETFs, because some of the biggest gold mining companies are outside of the US, so they have a lot of international exposure. Countries like Australia, South Africa, Canada. So they should be aware of the currency factor. And our currency risk is not much of a concern as of now, because the dollar's rally has kind of petered out. But if the dollar, resumes its uptrend, then the currency factor will also affect these ETFs.
All right, and speaking of them, the minor ETFs, you've got a couple to share.
Yes, yeah, both are by market vectors. The first one is gold miners ETFs with ticker GDX, 5.7 billion in assets under management, charges and expense ratio of 53 basis points. The other one is called Market Vectors Junior Gold Miners ETFs. It invests in smaller companies, as the name suggests. Also quite popular, similar kind of expense ratio, but obviously more risky than. It is more risky to invest in smaller companies than in bigger companies.
All right, do you own any of the ones you mentioned?
Yes, I own gold ETFs, both GLD and IAU.
Okay. All right. Thanks for the information. We'll keep our eyes on the price of gold here going forward. In the meantime, if you would like to check out more ETF information and you're not at our website, Zacks.com, watching this video, then get on over to the homepage and use the top toolbar. You can use the Funds tab in that top toolbar, and that'll cause another drop down to happen and take you right to another tab for ETF information. Meantime, with Nina, I'm Terry Ruffalo.